Hey everyone, welcome back to Corporate Decoder. In this video we will talk about Natural Gas Services Group Inc. and the latest financial report, a 10Q filing for the quarter ending June 30, 2025. And let me tell you, this report definitely has some interesting movements, making us wonder what the future holds. Alright, let's dive into what this filing tells us about Natural Gas Services Group Inc. or NGS as they're known. They are in the business of renting, designing, selling, installing, servicing, and maintaining natural gas and electric compressors for the energy industry, mostly for oil and gas production. Let's kick things off by looking at their balance sheet as of June 30, 2025, compared to December 31, 2024. One of the most striking figures here is their rental equipment. It's grown significantly from $415 million at the end of last year to over $446 million now. This shows they are investing heavily in their core rental business, which generally means they expect good returns from this segment. Overall, their total assets have also increased from about $492 million to over $525 million. This growth is mostly driven by that rental equipment investment. On the other side of the coin, their long-term debt has increased from $170 million to $182 million. This typically means they are borrowing more money to fund their growth. It's always important to keep an eye on debt levels, especially when interest rates can fluctuate. Now, let's move on to how they are performing operationally by looking at their income statement for the 3 and 6 month periods ending June 30, 2025 compared to 2024. Rental revenue is looking strong, up from about $34.9 million in the second quarter of last year to nearly $39.6 million this year. For the 6 month period, it's even better, jumping from $68.6 million to $78.5 million. This is a solid increase, showing healthy demand for their rental services. Aftermarket services, which is keeping their customers' equipment running smoothly, saw a slight dip in revenue for the quarter, going from $1.3 million to about $1.05 million, but it was a smaller decline for the 6 month period. Sales, however, took a pretty big hit. Sales revenue dropped from $227 million in the second quarter of last year to just $75,000 this year. And for the 6 month period, it fell from $4.77 million to just $2.67 million. This substantial decrease in sales revenue is something to pay attention to. The company mentions a shift away from sales towards rentals and also some costs associated with closing their Midland, Texas facility, contributing to this sales performance. Their gross margin, which is the profit they make after directly paying for the goods or services sold, is reported at $15.3 million last year. That's a good improvement. And when they talk about adjusted gross margin, which is a non-GAAP measure they use for internal analysis, it's even higher at $24.2 million for the quarter, up from $21 million last year, showing that underlying business strength. Looking at the statement of stockholders' equity gives us a picture of how the owner's stake in the company has changed. Their retained earnings have grown steadily from about $151.5 million at the beginning of the year to over $61.5 million by the end of June this year. This indicates they are reinvesting their profits back into the business. Additional paid-in capital also saw a nice increase, reflecting stock-based compensation and option exercises. Now for cash flows. This is crucial because it shows the actual cash generated and used by the business. They generated a healthy $32.2 million in cash from operations in the first 6 months of 2025 compared to $31.1 million in the same period last year. This is positive news, showing their core business is generating cash. However, investing activities show a significant outflow of cash. They spent about $45 million on purchasing rental equipment, property, and other equipment in the first half of 2025. That's up from about $28 million last year. This aligns with their strategy of expanding their rental fleet. Financing activities show they borrowed a net amount of $10.8 million in the first 6 months of 2025. This implies they're using their credit facility to help fund their investments and general operations. The company operates in one business segment, primarily focused on renting compressors. They've also been closing down their fabrication, repair, and overhaul facility in Midland, Texas, which has led to some reclassifications of assets to held for sale. This move is part of a strategy to streamline operations and monetize real estate. Regarding their customers, over half of their revenue comes from Occidental Permian Ltd or Oxy. This is a significant customer concentration. While having a major customer can be good, it also carries risk. If something were to happen with Oxy, it could significantly impact NGS. Compensation is also a big part of their expenses. They have various stock-based compensation plans for their employees and board members. It's interesting to note the significant increase in equity classified stock-based compensation this year. This is largely due to a higher mix of performance-based share unit awards, which generally have a higher value. After the quarter ended June 30, 2025, NGS made a few notable announcements. They declared a dividend of 10 cents per share. Also, one of their senior executives, Brian Tucker, is transitioning out of his role as president and COO. And in a significant move, they approve a share repurchase program for up to $6 million. This suggests they believe their stock is undervalued and they are returning capital to shareholders. Now let's talk about the risks. NGS is very clear about the potential challenges they face. These include the volatility in oil and gas prices, changes in economic conditions, competition, and relying heavily on a few major customers like Oxy. They also mention operational risks, environmental regulations, and their ability to manage debt and financing. Reviewing the management discussion about their performance trends and outlook, they highlight continued demand for their higher horsepower units, which command higher rental rates. They are also focused on improving their rental fleet utilization. Technology like their smart system is helping them manage maintenance more efficiently to combat inflation. Their rental revenue is up significantly because they are growing their fleet of high horsepower units. This is a positive sign of their strategy paying off. As mentioned earlier, sales revenue has declined, and the company acknowledges that sales are less of a focus now compared to rentals. The negative adjusted gross margin for sales also points to the difficulty in making sales profitable when dealing with overhead. SG&A expenses did go up primarily due to higher information technology costs, public company costs, and salaries. This is expected as the company grows and operates in a public environment. The increase in equity classified stock-based compensation is also a factor here. Liquidity and capital resources. They have a significant credit facility that was recently increased to $400 million. As of June 30, 2025, they had about $172 million available, which provides them with good financial flexibility to fund their operations and growth plans. Top Treasury to fund their operations and growth plans. Dopplove.vg to fund their operations and growth plans. Tuju Kaplis Anad Grofanzal Access Services Group. They are clearly doubling down on their rental business with significant investments in equipment, and this is paying off with strong rental revenue growth. The move to higher horsepower units seems to be a smart bet given the higher margins they command. However, the reliance on Oxy as a major customer is a significant risk factor that can't be ignored. If Oxy's needs change or if they consolidate further, it could create headwinds for NGS. The decline in sales revenue also suggests a strategic shift, but it's important to ensure the remaining sales operations are efficient. The increasing debt level is something to monitor, especially with the current economic climate, but their improved cash flow from operations and available credit provide some comfort. They seem to be managing their costs reasonably well despite inflationary pressures thanks to their technology investments. Overall, NGS appears to be executing its strategy of focusing on rental income and expanding its high horsepower fleet. The future looks promising if they can continue to grow rentals and manage their customer concentration risk effectively. It will be interesting to see how the share repurchase program plays out and if it boosts shareholder value. Alright, that's our breakdown of Natural Gas Services Group's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.